Have you ever heard of a business that actually lost money but still had to write a check to the tax man? I know it sounds completely backward, right? But it's a real thing, all thanks to a tricky rule called the minimum tax. In this explainer, we're going to decode how this works and why the old no profit, no tax idea doesn't always apply. So let's dive in. So let's just get right to it. Can a business really be on the hook for taxes even when it doesn't make a single cent of profit? Well, the answer, and this might surprise you, is a big yes. And it all boils down to this concept of a minimum tax. Let's break down exactly how that's possible. Okay, think of it like this. Normally, your tax bill is based on your profit. If your profit is zero, your tax is zero. Simple. But with the minimum tax, the government has basically installed a tax floor. It's a baseline. So no matter how low your profits fall, even if you're in the red, your tax payment can't drop below this floor. It's a mandatory contribution to make sure every business pays at least something. All right, so how do we figure out where this tax floor is? Well, it's not just one fixed number. The tax code actually gives us two completely different paths to calculate it. To find your minimum tax, you've got to understand both of these methods. Let's see where they take us. So, our two paths are the withholding path and the revenue path. The first one is all about tax that's already been taken out of payments you receive. The second one? That's about the total amount of money your business brought in, your top-line sales. One looks at specific transactions, the other looks at the whole business. Let's start with the withholding path. All right, let's head down path one, the withholding method. This is all about the tax that gets deducted from your income before the money even hits your bank account. You can think of it as tax that's being prepaid on your behalf. You know, this path can actually be really simple. For certain kinds of income, whatever tax was already withheld from your payment, well, that is your minimum tax for that specific income. It's done. So if a client pays you and withholds 10% for taxes, that 10% could be the final minimum tax you owe on that particular payment. Pretty straightforward. But, and this is a big but, there are some really important rules to remember here. First off, that withheld tax is usually final. You can't get it back as a refund, and you can't use it to pay off other tax bills. It is what it is. Also, if your regular tax on that income ends up being higher, you've got to pay the higher amount. And finally, you can't mix and match. Any loss from this income can't be used to lower the profit from other parts of your business. It's like this income lives in its own little tax bubble. Okay, let's switch gears and talk about path two, the revenue method. Now, if the first path was about tax already paid, this one is all about your total sales. And this is where that whole profit doesn't matter idea really kicks into high gear. Here is the absolute key for the revenue method. Your tax is calculated on your total revenue, not your profit. I'm going to say that again. It's based on your revenue. It doesn't matter how high your expenses were. It doesn't matter if you technically lost money. The tax is based on every single dollar that came through the door, period. So does this apply to everyone? Nope. There are specific thresholds you need to hit. For companies, you need to pay attention if your total revenue or gross receipts is over 50 lakh taka. For individuals, that bar is set much higher at 3 crore taka. If your business is below these numbers, then you don't have to worry about this particular path. And as you can see, the rate isn't one size fits all. Not even close. It really depends on your industry. Tobacco and soda companies get hit with the highest rate at 3%. Mobile operators are at 2%, but for most other companies, it's a much lower 0.60%. And for individuals, it's just 0.25%. It just goes to show you how specific the tax code can get. But check this out. There's also a pretty cool incentive for new manufacturing businesses. To help them get off the ground, the government gives them a massive break. For their first 3 years in operation, their minimum tax rate is just 0.1% of their total revenue. It's a really powerful way to encourage new growth in that sector. So we keep using this term gross receipts. What does that actually mean? Well, think of it as every bit of money your business brings in from all sources: sales, service fees, commissions, you name it. The absolute key here is that it's the total amount before you take out any of your costs or expenses. It's your pure top-line number. Okay, we've walked down the withholding path and we've explored the revenue path. Now it's time for the main event. Let's put everything together and figure out how you get to your final tax bill. This is where the rubber meets the road. And this is probably the exact question you're asking right now. What happens if both of these situations apply to you? What if you have some income with tax withheld and your total revenue is over the threshold? Which path do you follow? It's a super common question, and thankfully, the answer is pretty clear. It's actually pretty straightforward. You have to calculate both. You work out your minimum tax using the withholding method, and then you work it out again using the revenue method. Then you just look at the two numbers, and whichever one is higher, that is your minimum tax. It's a simple higher of the two rule. So you found your tax floor. Now what? Well, there's one last comparison to make. You take that minimum tax number and you put it side by side with your regular tax, the one based on your actual profit. If your regular tax is higher, great, you pay that. But if your regular tax is lower than the minimum tax floor, well, you have to pay the floor. It's one last whichever is greater decision. Okay, so let's do a quick recap. First, the minimum tax is your tax floor. Second, you find that floor by looking at two paths, withholding or a percentage of revenue. Third, if both of those paths apply to you, your minimum tax is simply the higher of the two calculations. And finally, what you actually pay is the greater of your regular profit-based tax or that minimum tax floor. And that really leaves us with a huge question to think about. How does a tax system like this, one that taxes revenue and not just profit, change how you run a business? When you know you could owe taxes even in a year you lose money, it makes you think differently about pricing, costs, and even how fast you want to grow. It's a big reminder that in business, cash flow is just as important as profit. Thanks for joining us for